Thank you for joining Genesis and GreenPath for our webinar, Preparing for Home Ownership. We are excited that you joined us, and we look forward to providing you guidance on this very important topic. First, we'd like to introduce you to our panelists. I'm Bill Folks. I am a Partner Experience Manager with GreenPath. I started with GreenPath in 2008 as a financial counselor. We call them financial wellness experts now. I did that for about 6.5 years. In July 2015, I joined the partner experience team, working directly with our credit union partners. It's my honor and pleasure to be here working with Genesis and speaking directly with your Genesis members.
Hi, my name is Dawn Watson. I am too a partner experience manager with GreenPath. I've been with GreenPath for just over 30 years. The majority of that time was spent directly with individuals to provide education and resources to achieve financial goals, including home ownership. I am too also excited to join Genesis today to help you learn and prepare to become a homeowner. Lance, you want to take a moment to introduce yourself?
Yep. Good afternoon, everyone. My name is Lance Smith. I'm the mortgage production manager here at Genesis. I've been in the mortgage industry in various capacities for 32 years. So I've helped a lot of first-time home buyers and new homeowners over the years. So I've got a few things we can discuss along that path.
Right. So for our agenda today, we are going to go over benefits of owning a home, credit fundamentals, some mortgage basics, looking for a home and calculating that affordability, obtaining your mortgage, a loan approval phase, preparing for closing, and then maintaining your home ownership once you've closed on the loan.
All right. So as we get started, we want to talk about the benefits of owning a home. Home ownership is a financial goal that many are working to achieve. For those of you on this call, I'm assuming you're here, and so for that, and that is going to apply for you. We want to highlight some of the many benefits to being a homeowner. One of them is the power of amortization, and that's what everyone is looking to achieve as a homeowner. As you make your monthly payments, the principal balance on the loan is reducing, while the equity, which is the value that you own of the home, increases. One main benefit of homeownership is you can always put more toward the principal, therefore increasing equity faster. Some people choose to make biweekly payments, which allows you to actually make a full extra payment once a year. This can shave years off your mortgage and save you thousands of dollars in interest this way. Appreciation is also a potential benefit of homeownership. As the home market gets better, like it has been recently, and values increases, this means you will have an increase in the value of your home if you choose to sell. You can also personalize your home, which is something you might not be able to do as a renter. You can do your own landscaping, paint the home whatever color you like, and change out items you don't. As a renter, you may need your landlord's permission before you do any of those things. You can also use your home as an asset when you look to retire or as an inheritance. This is something tangible that you can use to help establish financial security.
Great, thanks, Bill. So next we want to discuss items you should always consider when determining if this really is the right time to buy. And this is including completing knowing your financial requirements to buy the home, which can be rather significant. First, it's always important to understand your current financial picture. So review your budget, or if you don't have one, create a budget. You'll want to understand your income, all of those everyday expenses, the things that sneak up on us all the time, your debt obligations, and your savings to determine if now is that time to start working for purchasing. So GreenPath Financial Wellness would be happy to assist you in reviewing your spending plan to ensure you have a clear picture to make that informed choice. We also can have a budget template that can help you start that process. We'll send that out to you when we send out a copy of the recording. So in addition to reviewing your debt, your income and spending, your savings will be an important part of the home buyer readiness. Typically, you're going to need to show you have a down payment, money that can be put towards that balance, that the purchase price. Your closing costs, these are the fees you'll pay when finalizing a real estate transaction. They include things like your appraisal, your title search, and many more. You'll also need to have some cash reserves. This is money that you can show a lender that you still have available to cover unexpected expenses. And then if you are going to be getting gifts from family members, be sure to talk with your lender And Genesis is a great place to start. They have several loan options that can minimize some of these initial investments and those closing costs. So definitely, if you're ready to move forward, you should talk with one of their lenders. Also, it's important to keep in mind that you may have many new expenses as a homeowner that you may not have had as a renter. You're going to be responsible for the maintenance and upkeep. So if something breaks, there is no longer a landlord to call. We recommend that you try to save 1 to 4% of the home's value for maintenance. Just for an example, I live out in the country. We have a well in a septic field. And soon after we purchased the home that we are currently living in, our drain field stopped working, which was very unfortunate because it's a significant expense. And luckily we did have those cash reserves and we had started to build our maintenance fund. So what could have been a huge disaster, we were able to manage and maintain. So again, maintenance, having that cash reserve is really important. You're also going to be responsible for property taxes, homeowners insurance, and if you have a homeowners association fee, that will be your responsibility beyond just the principal and interest of your mortgage. And you're going to make sure that you can keep these payments in good standing. You may also have a water bill or a gas bill that previously was included in your rent. Also keep in mind that your utilities as a homeowner may be higher than they were as a renter, depending on the size of the home that you purchase. Now, for most, the goal of building equity is the purpose of purchasing a home. But you want to keep in mind how you plan to use that property that you're going to be purchasing. Will the property be your primary residence? Are you going to use it as a rental? Is this a short-term home, something that you're going to trade up soon? Or is this going to be the home for the rest of your life? You may have different lending requirements, increased taxes or insurance costs, depending on how you answer those questions. So again, you should talk with your lender as well as your insurance agent so that you can understand how that choice might impact you. You will also have limited flexibility as a homeowner. If you decide that you want to relocate for a job opportunity, potentially move closer to family, or just change neighborhoods, it may take longer to sell and be able to make that move. I know Bill and I just had a colleague that wanted to change neighborhoods. She had an unfortunate dog issue in her neighborhood, so she wanted to be able to move, and it took a little bit of time for that to happen. And again, it's always important to know your budget and determine what you can truly afford. If you need to make sacrifices in what would be your definition of that perfect home in order to buy now, then you'll want to be sure to consider this and determine if indeed this is the right time. Also consider future changes. Are you planning to start a family soon and will have additional expenses? Do you want to spend your money doing something different? Can you afford it all? If not, what are you willing to flex on? We don't want this exciting adventure to become a stressful and feel like you're living paycheck to paycheck.
All right. So reviewing your credit report is also going to be an essential part of preparing to purchase a home. In addition to having savings for down payment and closing costs, the mortgage lender is also going to review your credit report. The credit report will provide the lender with your credit score based on your payment history and your credit usage history. There are 3 credit bureaus that the lender may obtain your information from: Equifax, Experian, and TransUnion. They may look at any of those, or they may look at all 3. We would recommend that you review your credit report before applying for a mortgage or any other type of loan. And if you find any errors, be sure to address those with the credit bureau. You can do this for free at annualcreditreport.com. That's where you can get your free credit report. And whenever I talk about this, I always tell everyone, don't go to free credit report. Those are the ones, that's where you see the guys in the commercial singing. That is not free. You're paying for a monitoring service with that. You want to go to annualcreditreport.com. Now, your credit score is calculated based on your payment history, and this reflects how likely you are to pay your bills, or likely you are to pay your bills as you've agreed to do so. And your payment history represents about 35% of your overall score. The amount of debt that you owe or that you have makes up about 30%. 15% of your credit score is based on the length of time you've had credit. And rounding that out at about 10% each is the mix of credit. In other words, what types of credit you have and how much new credit you have. The mix shows how you've handled a variety of different credit types of debt, and if you've handled them responsibly. And if you have a lot of new credit, that could be a red flag for any potential creditors. If you haven't reviewed your credit report recently, or you're unsure how to read it and would like someone to review it with you, please contact GreenPath for a free confidential credit report review, and this will not impact your credit score. As a soft pull, it will not affect your credit score. So now that we've gotten some of the fundamentals of credit, let's take a look at credit, at some of the bases of buying a home, and Lance is going to help us out with that.
Thank you, Bill. So you're probably going to figure out quickly that this process is more complicated than a lot of the loans that you may have gotten in the past. I'm going to cover some of the basics, and then I'm going to give you, some paths that you can get more detailed information as you move along. So some of the basics, you've got two primary types of loans. You've got government loans and you've got conventional loans. Government loans typically are more costly. There's additional fees associated to them, and they are sponsored by a government entity. So you may have heard of FHA loans, which are Federal Housing Association loans, VA loans, which are backed by the Veterans Affairs Association, MISTA, which is Michigan State Housing Development Authority, and then you have USDA, which is a rural development loan. And you're probably thinking, why would I get a government loan if it costs more money? Well, the bottom line is there are often better requirements. You can have lower down payments, and you might have lower credit standards. So you pay a little bit, but they give you a little bit deeper standards. The other type of loan is a conventional loan, which is not backed by a government entity. It's written by a credit union, a bank, a mortgage company, and often they're sold to Fannie Mae or Freddie Mac. And they have different loan standards and different fees and different rates. But conventional loans, you can have as low as 3% down. There's something called a home ready loan, which is for first-time home buyers. And it's a relatively low cost loan, but you do have to have fairly good credit. The typical conventional loan is 20% down. Well, a lot of people, especially first-time home buyers, obviously don't have 20% down. So there's what's called private mortgage insurance, which is insurance that is backed by, like it sounds, a private company that puts insurance on your loan and a whole bunch of other loans. They put it in a pool, and if there's defaults, they pay out the loan to the lender. So it backs it for the lender like a government loan is backed by the government. So similar, and if you got the right credit, it's typically going to be less expensive than a government loan. We offer loans at Genesis that are as little as 5% down with no mortgage insurance. So there are products out there, if you have good, strong credit, you can qualify in other ways that you can have a low down payment and not have mortgage insurance. Loan terms typically range from 10 years to 30 years. I think the typical first-time home buyer really ought to be looking at a loan that's got a 30-year amortization on it, so you keep your payment down as low as you can. So as Don was saying, you can make sure you can afford all those other things that are going to come along with home ownership, things that you can't think about right now. And then you have fixed rate loans and you have adjustable rate loans, which right now, probably everybody's aware that inflation's kind of through the roof right now. Fixed rate loans have moved up substantially. So you've got fixed rate and you've got adjustable rate loans. Well, adjustable rate loans are fixed for a period of time and then they adjust. Well, those rates are a lot lower right now because the fixed period, there's not as much risk to the lender because it's only fixed for 5, 7, 10 years versus 30 years. So on a 30-year loan, you're going to have to pay a higher rate because there's more rate risk to the lender. But if you're looking at a home and you're thinking, we're going to live here, it's our starter home, we're going to be here 5 years and then we're going to move up, or 7 years, we're going to move up. An adjustable rate loan is a great way to go because you can save money on the interest, lower payment. It just makes sense. And you can even, to try and build equity into that property so that when you get to the 5 or 7 year mark, you can pay the payment that you would have paid on a fixed rate loan, and you can drop that loan balance down. So when you're ready to move up, you've got equity in the home. So right now, you want to really understand the difference between the loans. So I think adjustable rate loans are a great way to go. Then you have the principal, interest, taxes, insurance, and association fees. So that's the total payment that you're going to be responsible for, which, as these guys have talked about, it's really important for you, for the lender, to really understand what is my total payment going to be. And with the other factors that go along with home ownership, water bills and electricity and repairs, having enough in your budget to pay everything associated with it is critically important. So it's, when you go into this process a little bit further, it's very important you understand the budget, you know what you have left over, and you know what that total payment is going to be after you buy the home. When you purchase a home, if you buy from more than somebody has been paying taxes on, the taxes are going to go up. You want to calculate what they're going to go to, not what they are today, so that you understand the full payment. Okay, let's look at getting pre-qualified now. So one of the, I think, really most important steps in the home buying process is to get pre-qualified. So you find a lender, of course, at Genesis Credit Union, and they will go through all of your debts and your income, determine what you can afford for a maximum house payment. So that would be the maximum you can afford: principal, interest, taxes, insurance, and association fees. I don't encourage somebody that's a first-time home buyer to necessarily go to the max that we tell you can go to. It's a good way to get in trouble. I mean, you got to really understand what is it that you feel you can afford, and probably before you get into that house, figure out what that total payment is and make sure that you're able to make that payment. If the lender tells you it's going to be $1,500 for the total payment if you buy a house in this area for that amount, and you're paying $1,000 in rent right now, well, for a couple of months, you probably ought to pay your rent and make sure that you can put $500 into savings. If you can't do that, then maybe the answer is that's too high a payment. You can start the pre-qualifying process by going to the Genesis website and picking out a mortgage consultant that is either near where you want to buy or from your current branch, however you want to do it, or you can just walk into your current branch and one of our people will refer you to a mortgage consultant. So to do a pre-qualification, which you can do off of our website, you're going to need to supply some basic information to the lender, to my mortgage consultant, a couple of pay stubs, tax returns if you're self-employed, some information about obviously all of your debts, and funds you have available for down payment closing costs. So once you're pre-qualified, it's time to go find a home and apply for a mortgage. So obtaining a mortgage, when you do the pre-qualification, your mortgage consultant is going to probably give you additional information that you're going to need to have to apply for the house. So you might have given a pay stub up front. Now you're going to need to come up with your last 2 years W-2s, additional pay stubs. They need to be within the last 30 days, bank statements, gift funds if you're getting them, grants if that's appropriate, whatever you're going to use for income and assets to qualify for the loan. And then there may be other things that through your discussion with them, they're going to say, hey, you need to get this. It could be a long list, so I'm not going to go into those details right now. The other thing is to really figure out what product best suits you. Should you get a fixed rate loan because this is your dream house, you are 100% confident you're going to live there forever, or does one of the adjustable rate products make sense? So you're going to talk through that with your mortgage consultant. All right, so now let's look at the mortgage process, which, as you can see, I wanted all these little circles on here so that you get a little bit of an appreciation for the fact that this process is a lot more complicated than getting, say, a car loan. There's just a lot more to it. It's the biggest purchase you're probably ever going to have in your life. It's also the biggest, type of loan for the most part that lenders do. So there's a lot more regulation. So you start by applying. You're going to do that through your mortgage consultant. It can be online or they can take your application. You're going to get a whole bunch of disclosures, which can either be printed and signed with a pen, or you can do it digitally, which is what most of them are done. We send this package to you and you just electronically sign off on it, but it's like 150 pages. I encourage you to, not just blow it off. Take a look at it. Make sure you understand what you're getting into. What do the disclosures say? How much are you going to need for closing costs? What are these closing costs? Question things. And then from there, you sign everything, give us the permission to move forward. And then it goes into initial processing. We get title work, appraisal. We verify your employment, verify your deposits, verify gift funds, verify whatever it is we need to verify. We do all those things, get all that put together, then it goes into underwriting. So that's where, somebody specialized in whatever type of loan is going to look at it and make sure that based on all the information we put together, that you qualify for the loan. They will then approve the loan. If everything's put together perfectly to start with, it'll be approved and ready to close. It almost never happens, but it could happen. Assuming it doesn't, you'll need to gather probably some additional information that the underwriter tells you need to have. You supply that, and then it will go through some additional processing and then go back into underwriting for a final clear to close, which is really where that's one of our big milestone steps. We need to get to a clear to close. And when we get to that point, we're going to send you another set of disclosures, which are going to have a more refined set of your final closing figures. And that's called a closing disclosure. And from that, we're going to get a closing schedule. And now it's time for the day you've all been waiting for, the closing. And just before that, we're going to have you get homeowners insurance. So that's insurance. I talked about government insurance and private mortgage insurance, et cetera. This is insurance on your home that if there's a fire, a flood, et cetera, it insures your home and the replacement of it if something happens. So you're going to need to get that. It'll be part of either your total closing or you can pay for it up front. And then you're going to get a final closing disclosure a little closer to the closing date. And that's going to tell you the amount of funds you need to wire to the title company for the closing. Then it's the day you've all been waiting for. It's time to sign. So you go in and you're going to sign literally another 150 pages worth of stuff. And you get the keys to the house and away you go.
Great. Thanks, Lance, for all that wonderful information. So now that you've closed on your loan, you've taken possession, you're celebrating, don't forget there are still a few things that you need to do to successfully maintain that home loan. First, you're going to want to confirm you know the correct amount of your payment and when your first payment is going to be due. You may want to consider setting up a direct debit to avoid falling behind or missing that due date. Second, if you do have homeowners association, a townhome or co-op, and there's additional fees that need to be paid, they aren't going to go to the mortgage lender. They need to go to that individual entity. So you're going to want to make sure you know who those payments are sent to, the frequency that you need to pay it. Sometimes the homeowners association fees are due every month. Other times you pay it annually or quarterly. So make sure that you understand the frequency and where those payments go. Third, consider if your budget can support those extra payments to principal to speed up that equity growth. I know we've talked about it a little bit before, but this is a great way to try to save money. So for example, if you take out a 30-year, $120,000 mortgage at 4.5% interest, and you make your minimum payments each month, you're going to pay $98,888 in interest, almost the amount of the principal payment. If you can make a biweekly payment, so that extra payment per year that will get applied, you're going to reduce the time to pay off that loan from 30 years to 25 years and 9 months. So again, just over 4 years of savings that you won't have a mortgage payment or principal interest payment. And that total interest is going to drop down to $82,870. So you have a total savings of $16,000, $16,018. That's a lot of interest and time saved. So if you can't afford to do biweekly payments, it just seems a little overwhelming, especially if you're a first-time homeowner. It's okay. Check with your lender. Talk about how you can send in extra principal payments whenever you do have that extra money Maybe you can do it when you get some tax return money, or on, sometimes when you have your 3 paycheck or extra paycheck months, you could send in a little extra. So really talk to the lender about that option.
All right. And fourth, you want to make sure you continue to review any communication from your lender. Each year, the lender will review your escrow account, and that's where the money is set aside to pay things like your taxes, insurance, and homeowner association fee if you have one. As with everything in life, these expenses may change each year. If there is a change, it's going to impact how much is collected for your escrow account, which will in turn affect your payment. So be prepared for occasional adjustments. If this were to happen, the lender will notify you of the change, and assuming it's an increase, your monthly payment will change. This doesn't impact the term of your mortgage or the interest rates. If you have an interest rate, your rate isn't changing, it's going to stay fixed, but your payment will increase to cover increases in the taxes, insurance, and association fees that the lender pays on your behalf. Finally, it's important to continue to fund your emergency, your home or home maintenance account. Emergencies are going to happen. It's not a matter of if, it's definitely a matter of when it's going to happen. But being prepared will increase your ability to take care of these without having to go into debt or having to make tough decisions about what's going to get paid and what's not going to get paid that month. If you are concerned that you might miss a mortgage payment, please go ahead, reach out to your lender or talk to one of Green Path's HUD-approved housing counseling agencies. And counseling with a Green Path agent is always free. You can reach out to us at 877-274-7580. And once again, that's always a free conversation, and it is always confidential.
All right. So we want to make sure that we can take all of your questions. So if you could please put in the chat feature any questions, please send it to all panelists. So all of us are going to be able to see those and be able to get those answered. And as we have them pop in, we'll be able to make sure we get those that information for you. So it looks like, Lance, we had a question that had come through about what exactly is Fannie Mae and Freddie Mac.
Fannie Mae and Freddie Mac are what people might term a quasi-governmental entity, which essentially the federal government kind of makes a market in mortgages. So they take loans from all over, all different lenders, credit unions, banks, mortgage companies, etc., finance companies, and they pool them together and they sell bonds with the mortgages as the backing for those bonds. So what that does is provides liquidity in the mortgage market so that, if we just lent out to all of our members, for everybody's mortgage, we'd run out of money. We wouldn't be able to lend. So we sell some of those loans to Fannie and Freddie. They package them up and they sell off bonds, and then that frees up the banks, the credit unions, et cetera's capital to lend to more people. And it also provides lower interest rates. If banks had to use all their own money, the rates would be substantially higher than they are because they'd have to make sure they leverage their capital to the highest degree. So it's really to make a market for mortgages.
Okay, thanks, Lance.
We
So
actually
have
we have
another question.
Go ahead, Dawn.
Okay, so we have another question. It says, is there a checklist for what to bring for that pre-qualification meeting?
Yes, I mean, the main thing would be income information, which would be pay stubs, and then have a list of what you have as far as assets and other areas that you might be able to get cash, like gifts, etc. Those are really the main things up front. We're going to take your social security number. We're going to pull your credits. So we're going to know what most of your debts are. If you have a debt that is not reported on the credit bureau, then I would, you got to make sure that you let your mortgage consultant know that. Like I said, they're going to provide you with another list after you have that pre-qualification. So the first step is fairly basic. It's the next one that's going to get a little bit more lengthy, I think.
Right. So keep throwing those questions into the chat. Looks like another one that came in was about what do you need to do to qualify for the 5% no PMI loan program? Sounds very intriguing.
Yeah. Right now, our standard is you got to have a minimum of 700 FICO score, and it has to be a purchase loan. Those are the main criteria. Debt ratio can't be over 45%, which I wouldn't encourage anyone to go ever over 45%, to be honest. I think that's probably too high. So those are the main pieces to it. Like I said, there are other Fannie and Freddie programs that we can put you into that would have a little lower down payment or and possibly a lower FICO, but that's to qualify for our product. And there's also other products that we will do in our portfolio that we require mortgage insurance, but still a low cost. You can do an ARM loan with mortgage insurance that still be at a very reasonable cost.
All right. So somebody popped in, how do you calculate the debt ratio?
Well, basic terms, you take all your monthly debts plus the principal, interest, taxes, insurance, and association fees. Add that together and divide it by your gross. That is one of the keys, your gross monthly income. Now, there are certain income qualifiers, and this is why pre-qualification is very important. If, let's say you have, and I guess it's an unfortunate situation as to where we're at right now, but some people have, you have a full-time job and then they may have a part-time job too. Well, the full-time job, we're almost certainly going to be able to take that and include that in your income. But then there's other qualifiers for a part-time job to count as income. The rule is, and there's a lot of, the rule book's very thick, so I can't go through all of them, but the general rule is that you have to be there at least 2 years. So if you just started a part-time job 2 months ago, we may not be able to, we probably can't use that income. Then you have other income that might be kind of off the books. Tip income is one of the key ones that we see. If you don't report it on your taxes or through your pay stub, we can't use it. It's not verifiable. So we're really looking at, income that you've had typically over a 2-year period. Full-time jobs are a little different, but that we can verify you've had it and it's been there and stable for the last 2 years and expect it will continue. And it needs to be reported. Can't take cash. So I'm sorry, I didn't answer the final question. Sorry. So you take the total debts and you divide it by the gross monthly income that we can use, and that ratio is what we're looking at. And so the maximum is 45%. But again, that's where when we talk about all the budget pieces to it, you got to make sure that, when you take that total amount there at 45%, you're going to have X amount left over after tax. Even though we're using gross, you've got to think about your after tax money, right? So if you make $4,000 a month, but you only bring home $3,000, I might tell you can afford $2,500 in total debt. That's not right. It'd be roughly $1,800. Well, so that would leave you $700 in income. Does $700 cover your other expenses? Your trip to Myers, your kids' Little League. I mean, all that stuff. You need to take all that into account. That's part of the budget process that you really need to do before you jump fully into this.
I think the biggest one too that is a huge expense that isn't part of your debt to income is childcare, which, if you're paying that out, that's another one to keep in mind.
Yeah.
So we do have another question in here. Is there a maximum loan amount for that 5% down, no PMI loan option?
Conventional limits, which right now is 648.5 or something. I mean, it's a big number.
Right. So it looks like another question came in about down payment and the funds that can be used for that. Can you use community grant money to do the down payment?
Absolutely.
There's another question that says, is there a length of time that the pre-qualification is good for?
Typically 120 days, because the credit report is only good for 120 days. So after that, we have to pull a new credit report. So we typically just put a time limit of 120 days on it. Now, the reality is, if you find a house 90 days in, it's got to close within 120 days of the original pre-qualification. So in that situation, we may need to pull credit before the end of it if it takes more than 30 days to get you closed. But right now we're running fairly quick. Hopefully we can get it done in 30 days, but then you have to, can the seller do it, et cetera.
All right, any other questions that you want to pop into the chat for us? Do you see any others, Bill?
Nope, I don't see any questions. That looked like it was the last one about the length of time for qualification.
Okay, these are great questions. Got your mortgage loan expert here, so if you have more, please pop them
Any
in.
other questions?
All right. So again, if you have mortgage questions specific to you and you want to look at applying for a mortgage, definitely reach out to Genesis. Again, you can go into the branch, you can call them, you can look on their website to try to get some information. I think that Lance said you could start the pre-approval process there, so definitely go there. You'll see their contact information on the screen. Also, if you would like to go through and help us, do a budget with you so that you can kind of see, can you afford what they're saying that you could technically qualify for, or do you have some of those extra expenses that might make it difficult for you to maintain that higher payment? Reach out to GreenPath. We're partnered with Genesis. We're here to support you on those needs. If you'd like to take a peek at your credit report before you actually make the approval process, we can do that with you as well. When we pull a credit report, we don't pull all three, but we can look at the TransUnion as a soft inquiry. So again, not affecting your credit, but it'll give you a sense of where you're at before you start that actual process. But we also offer other types of services. So if you know individuals that might be struggling with their mortgage payment and you don't want to be that person and you want to have them refer over to us for their help, we can help them there as well. Again, reach out to Genesis at 800-521-8440 or reach out to GreenPath at 877-274-7580. Or you can also check out our website at greenpath.com/Genesis to learn more about our services and a little bit more about GreenPath.
Okay. Well, thanks, everybody.
Yes, thank you.
Thank you everyone for joining us, and look to see you guys real soon at the next Genesis webinar. Everyone have a great day.